Welcome to your daily market briefing. Here are the key headlines shaping today's markets. 1. US-Iran nuclear talks advance with guiding principles agreement. 2. AI disruption fears trigger broad sector sell-off across markets. 3. UK labor market softens, while Germany economic sentiment disappoints. After the headlines, you'll find a global market snapshot and a forward calendar of what to watch. Before we turn to today's stories, a short introduction. Daily Market Briefing. Think ahead, every market day. Subscribe to stay focused on what matters. Please keep in mind that all content in this video is for educational purposes only. It provides market context, not financial advice. 1. US-Iran nuclear talks advance with guiding principles agreement. Primary asset classes impacted. Brent and WTI crude, gold, USD JPY and safe haven FX pairs, US Treasuries across curve, defense and energy equities. What happened? Second-round indirect talks in Geneva concluded with Iran and US agreeing on guiding principles for potential deal. Foreign Minister Araghchi said path toward agreement has begun with drafts to be exchanged. Trump stated optimism despite threatening military action if diplomacy fails. Iran conducted naval drills near Strait of Hormuz ahead of discussions. Why it matters. Strait of Hormuz handles significant Gulf crude exports. Any disruption immediately tightens global supply. Risk premium embedded in oil prices could rapidly dissipate if diplomatic progress continues, pressuring Brent and WTI lower. Conversely, negotiation breakdown raises military strike risk, spiking energy prices and safe haven demand. Reduction in geopolitical premium would strengthen risk appetite, supporting equities while weakening gold and defensive positions. Deal progress removes tail risk, supporting elevated oil valuations. Key numbers to remember. Brent crude at $68.22 on February 17th, down from $69.85 February 11th high. Gold fell to $4,949 per ounce, retreating from recent peaks amid diplomatic optimism. Iran previously enriched uranium to near weapons grade before June Israeli strikes. What to watch next? Next negotiation round expected in approximately 2 weeks after draft exchange. Monitor U.S. military positioning in region and Iranian responses to gauge escalation risk. Saudi crude pricing and OPEC output decisions will signal production strategy if tensions ease. UK Brent futures curve steepness indicates market expectation of supply normalization. Sustained diplomatic progress could drive oil toward $60 to $65 range, unwinding geopolitical premium and pressuring energy equities while supporting global growth-sensitive assets. 2. AI disruption fears trigger broad sector sell-off across markets. Primary asset classes impacted. U.S. technology and financial equities, European software and industrial stocks, Stocks 50 financials, Nasdaq 100, S&P 500 communication services and financial sectors. What happened? New AI tools from Altruist and other startups sparked sharp declines across wealth management, software, insurance, logistics, real estate sectors. Charles Schwab, Raymond James, LPL Financial fell over 7%. European Dassault Systems plunged 22%. Anthropic releases and smaller firm innovations triggered indiscriminate selling of disruption-vulnerable companies. AI morphed from market savior to perceived marauder. Why it matters. Markets repricing entire industries for structural revenue threat as AI automates white-collar functions from legal work to wealth advisory. Software names lost $300 billion market value in single session. Shift from AI infrastructure spending thesis to disruption reality compresses multiples across sectors previously considered defensible. Elevated valuations amplify downside as investors reassess sustainability of margins and growth. Technology sector weakness bleeds into broader indices given heavy concentration. Financial services face dual pressure from automation and valuation compression. Key numbers to remember. Nasdaq down 2.1% for week ending February 14th, fifth consecutive weekly loss. Goldman software basket fell 6% single day, worst since April tariff sell-off. Financial services index tumbled nearly 7% on disruption fears. What to watch next? Wednesday, FOMC minutes and Friday, core PCE data will determine if rate cut expectations can offset technology weakness. Earnings commentary from software and financial firms about AI impact critical for sector stabilization. Monitor whether sell-off remains sector-specific or spreads to broader market as disruption concerns escalate. Defensive rotation into utilities and traditional value continues if technology pressure persists. Valuation reset could stabilize if earnings resilience demonstrated, but extended multiple compression likely if revenue models threatened across industries. 3. UK labor market softens, while Germany economic sentiment disappoints. Primary asset classes impacted: GBP/USD, EUR/USD, UK gilts especially 10Y, German bunds, European equities including FTSE 100 and DAX, Euro stocks 50 banks and cyclicals. What happened? UK unemployment rose to 5.2%, highest since early 2021. Private sector wage growth slowed to 5-year low of 3.4%, key metric for BOE policy. Employment change accelerated in December. Germany. ZEW expectations component fell to 58.3 from 59.6, missing forecast of 65 despite 2 prior strong gains. Current assessment improved to -65.9 from -72.7. Why it matters. Weaker UK wage growth reduces inflation persistence concerns, strengthening case for additional BOE rate cuts beyond 2 priced for 2026. Market now expects roughly 90% probability of 225 basis point cuts. Sterling pressure reflects dovish repricing as inflation path toward 2% target becomes clearer. Germany data confirms fragile recovery with structural industrial challenges persisting despite export sector improvement. ECB maintains accommodative stance as growth remains subdued. Divergence from Fed policy supports euro weakness. Combined European softness pressures regional equities and widens spreads. Key numbers to remember. UK unemployment at 5.2%, highest since early 2021. UK private sector wage growth at 3.4%, 5-year low. Germany ZEW expectations at 58.3 versus 65 forecast, current conditions at -65.9. What to watch next? Wednesday, UK, January CP. I release critical for BOE rate path. Consensus expects decline to 3% from 3.4% in December. Further wage moderation would cement dovish pivot. Germany needs structural reforms to address industrial sector weakness beyond cyclical improvements. Monitor ECB commentary on policy divergence as Fed potentially cuts while maintaining restrictive stance longer. Weaker European data combined with US resilience could extend EUR/USD downside toward 1.17 support. Sterling similarly vulnerable below 1.35 if inflation prints soft and BOE signals accelerated easing. This global market snapshot is designed for quick reference. You may pause the video to examine the data more closely. This forward calendar section is designed for quick reference. You may pause the video to examine the data more closely. Thank you for watching today's briefing. In markets, understanding the field matters as much as making the move. And that's the perspective we aim to provide. Subscribe to Daily Market Briefing and turn on notifications to stay focused on what matters every market day.